All right, let's break it down today. Japan has initiated a hike, and we'll see how this is going to affect the market. So stay tuned right here. Let's get into it. I do want to thank our sponsor, and that is Tangem. This is where you guys can get into self-custody in times like this. This is probably a good thing, and that is to try to weather a storm. One of the things you can do, of course, is drop your crypto into self-custody. Of course, visit tangem.com. You guys can learn a little bit more about self-custody. If you're brand new to crypto, this should be on your checklist of something you should be doing, and you can do it in 3 minutes or less. It's that easy to set up. Of course, this works like a credit card with your iPhone, with your Android, doesn't really matter. This is your way to get into self-custody. Use our link down below. Let's get into a couple of points I wanted to hit on. The Bank of Japan has confirmed it's going to increase rates. This will go to 75 basis points tomorrow. And then if you look at this in comparison, since 2024, each BOJ rate has been followed by a Bitcoin drop of around 30%. Right now, we did a quick poll, and the market says, yeah, we're cooked. This is what we're going to see in the market as we see the next few days. But it was not necessarily a full win. In reality, yes, but altcoins rally and no, Bitcoin and crypto have bottomed, took over 50% of the vote. So maybe there is a certain contingent that simply says this is a short period of time before we start to see a little bit of action. Let me go over to a clip real quick because this will get into the Treasury threat and what this means. Take a look.
Japan holds between $1.1 and $1.2 trillion in U.S. Treasuries. That makes them our largest foreign creditor, the single biggest source of foreign funding for our government spending. Imagine you could borrow money at negative interest rates, not 0% negative, meaning someone actually pays you to take their money. When the Bank of Japan raises interest rates, that free money becomes expensive money. Suddenly, those Japanese investors who were getting paid to borrow yen are now paying 1%. What do? They sell. They dump U.S. Treasury bonds, convert the dollars back to yen, and repay their loans before the math gets even worse. If Japan decides to sell even 10 to 20% of their holdings, we're talking about flooding the market with $100 to $200 billion in Treasury bonds that need new buyers. That kind of supply overwhelms demand, spikes yields, and creates a cascading crisis that hits both the bond market and stock market simultaneously. They stated this unwinding could contribute to a rise in U.S. government bond yields. That could be a trigger for the bursting of the artificial intelligence bubble. Let that sink in for a moment. We're not just talking about bond market stress. We're talking about a potential cascade that pops the AI stock bubble that's been driving our market higher. When safe Treasury yields spike, risky tech stocks priced at 50 to 100 times earnings become impossible to justify.
All right, so as you can see, this is a serious situation that is going to start unwinding in terms of the Japanese reverse carry trade. Treasuries are going to take a hit. The question is whether or not the market will respond in the same capacity. Do we see a market fall off after an all-time high in the S&P? Do we see gold becoming a safe haven asset? Or do we see risk assets starting to look a little differently to investors as we see those come down? Those are all the things that are playing out right now. The countdown, of course, is underway. Will the U.S. stock market repeat Black Monday? If you look back in history, the market's greatest concern is the recurrence, I should say, of Black Monday, which was a big unwind of carry trades similar to what we're seeing here. And remember, the S&P has hit multiple highs over just the last 90 days. So this continues to put a lot of pressure. And a lot of that has been driven by the AI bubble, if you want to call it a bubble. Or is this going to be another segue into possibly seeing what we could do within the whole idea around stablecoins? Because essentially you buy a stablecoin, that of course is going against a U.S. Treasury. That could be one of the things that's easing out on this. Stablecoin market not necessarily large enough to be able to soak that up yet, but it will be interesting to watch how this moves. Present, this sense of panic has significantly eased. The market still is almost fully priced in the quarter basis point interest rate. I think the question is how many of the Japanese bond sellers will actually go to market with that? And are they concerned about additional hikes? And that's the question that many people will say at that point, yes, the market could see a big issue. That could mean a little bit of a stability scenario that plays out. But our anticipation is that the market may not necessarily respond positively. AI stocks are dominating the equity markets right now. They reflect about 23% of global market cap, nearly all-time high. And if you look at this in comparison, the percentage has doubled since just 22. And this obviously was when ChatGPT was introduced. These stocks have also been primarily the driver of the global bull market that we've seen over really the last 3 years, and continues to see even maybe the push into crypto, because a lot of people were taking profits, moving that into risk. Risk, of course, went up to 126 on Bitcoin. Those are the kind of things that could play out here again, depending on how far the market falls. So AI is definitely redefining the market overall. If you look at the complexity of these companies and why it's such a contagion potential, this is the layout of how NVIDIA fuels most of the money machine within all these companies. And you're going to see companies like Microsoft in there, CoreWeave. You can get into obviously what's happening over there at Oracle, XAI, AMD. Then you get into all these mid caps, Figure, Mistral, Intel. All of these are centered around NVIDIA, primarily OpenAI, and then Microsoft. So those are the ones to keep a close eye on how this market responds to what's going on in Japan. Bitcoin dumped after 3 triple witching events. This is what they call it, the triple witching. And this has happened in a quarterly event where stock options, and index futures all expire simultaneously. So this is where we are right now. Do we see Bitcoin respond to that afterwards? Continue down? Could we see a 70K Bitcoin? Let me know what you guys think in the comments. Do you think this is the time where Bitcoin starts to make its move in a downward fashion? Or do you think this actually flips and we go bullish on risk assets? You could go on the contrarian side. Markets ended this week all selling off. And if you look at Bitcoin, even though this week 2.4, ETH 2.3, the run up on this, both ETH and Bitcoin, has been leading up for many, many weeks. So it's possible that has all been looking at what's going on in the Bank of Japan. And they're hinting at more rates. And I think that is the real question in 2026. Last time BOJ raised rates, the crypto market dumped. But this time, the market isn't waiting. They're going ahead of it. So this might mean you come out of it faster in risk assets. All that's still pending on how it performs. All right, so let's take a look at this, because there are things that correlate to the Fed and how they're responding. Because remember, with Bank of Japan, you got a rate hike. With the United States and the Fed, you've got a rate cut. Now, Ken Griffin of Citadel said, well, wait a minute. You can't really deal with this because we're talking about inflation still getting worse, and you can't blame the Fed any longer if inflation is continuing to move. This, of course, is going to play down for the Trump administration. Listen to this clip.
This is a real issue. And when the White House usurps control of the Fed, even if they don't actually have it as a practical matter, if they're perceived to control the Fed, then if inflation rears its ugly head, the president can't blame the chair of the Fed. Yeah. The buck stops on his desk. So I don't know why President Trump wants to take that risk in an environment where the outlook for inflation is so difficult to forecast or predict. And there is, again, a lot of pro-inflationary pressures that have been created by the change in labor markets, the high fiscal deficits, that is fiscal stimulus, and of course, right now, the relatively easy monetary policy.
All right, so as you can see, and this is something we've talked about quite a bit here, is that the Fed is really in a rock and a hard place. That we are ending up with higher inflation. It appears to be that it's not going to slow down. It may stabilize, but it's still higher, and which is always going to compound higher anyway. And you're dealing with an issue of job loss. Chris Waller, though, talks about this because it gets back into the job issue right now. Take a look at this one.
Well, earlier this summer, when the jobs numbers were looking very good, I had a lot of anecdotal evidence talking to CEOs around the country and other sources of soft data that told me the labor market wasn't doing that well. People were kind of like, what's he talking about? And then the August 1st, the July jobs report came out and everything was revised down pretty dramatically. And so we've now come around to this view that the labor market is very soft. The jobs numbers are around 50 to 60,000 the last couple months on average. We know that that's too high, and those are more likely to get revised down when we get the unemployment insurance administrative data later. It'll take a while before we get that, but board staff is estimating take off another 50 or 60,000 jobs. So we're close to zero job growth.
All right, just to be clear, I think this is a Fed governor, Waller. He's one of the guys that's in the potential line of being able to be a Fed chair. For him to first, and this is a Fed governor, for him who have all the data, supposedly have all the data, for them to finally come to the realization, after what I know we've been talking about here for at least a year, is that jobs are going to be the problem. They will be the problem, and they're not going to end being the problem in early 2026. It's very possible we could see this going into late rounds of 26 and continuing to see inflation going. This is stagflation at its worst. Powell is going to exit at maybe the best time for his career because he's going to get out right before what could be a huge implosion, and that means possibly a heavy recession that could play out in 2026. Now, how does that work within investing circles? We will see a drawdown, I think, on the S&P 500. I'm completely opposite of where Tom Lee is on this kind of permeable position, even though I am usually a bull because I know that that is where you're going to make money. So the way you get around this and start to hopefully defend is start to lay into where things are going to be going, and that is assets may be the way to fight inflation, may be the way to fight issues that we're dealing with right now economically. And this is something to look at. The wealthiest of U.S. households now with net worth above $1 billion hold 37% of their wealth in stocks, 35% in businesses. Those with $100 million to $1 billion, 58% in businesses, 10% in equities. And then by comparison, households with net worth under 10 grand, 36% of their assets in primary residence. That is a huge problem. And these vehicles, that's not an asset. That's not an asset at all. So you guys need to be driving Corollas. Everybody should be, if you get as much into real assets as you can, that's where this is going to change the game. Of course, if you look at the overall Americans' net worth under $1 million, this is the kind of thing we're dealing with right there. Let me kind of zoom in on this right here just to show you. The big blue category right there, those are all the good categories. The orange ones, not good categories, okay? Outside of liquid, I think that is still a position that still under 10K is decent. But this idea of where we're dealing with vehicles and primary residence, not that I'm not a big fan of real estate right now outside your primary residence, definitely not on real estate investing. I feel like it's just too long term. There are going to be some opportunities here going forward, guys. So if you're not part of our own private member, get in on that because I talk about this all the time on additional research that we drop over there so we can join for free. Just click the link down below. Catch me out there on X, @Paul Barron. We'll catch you next time right here on The Paul Barron Show.